Hey everyone, and thanks for jumping back into the cryptoverse. Today we're going to talk about Bitcoin. We're going to be looking at the move that we're currently in, down approximately 6%. So if you guys like the content, please go ahead and subscribe to the channel. Please give the video a thumbs up, and also check out the Telegram channel, which you can find a link to in the description below. So as you guys know, we've been following Bitcoin for a long time. We've been looking, we followed this entire reaccumulation range here, right? And said that we have these, these more or less stepping stones, right, on our path to 20K. And then speculating on this being a potential reaccumulation zone, and it still could be. But certainly, you can't deny the fact that for the time being, we have definitively fallen out of that reaccumulation zone that I feel like is mostly between, say, 10.9 up to around $12,000. Now, one of the things you'll see quite frequently, of course, is 10.5 mentioned. And why is 10.5 mentioned? Well, if you're not sure, you can see that the wick has currently gone down to 10.5. And the reason 10.5 is theoretically important is because it was the local top back in February. So back middle of February 2020, this was where our local top was, okay? So there's a lot of speculation that then we would hold some level of support at 10.5. Now, the optimist would say, okay, well, if we look at this, we can see that we held support at 10.5 over here, more or less, back in late July of 2020, and then we quickly rebounded back into the range. We had a wick down to almost 10.5 on August 2nd, and then quickly rebounded back into the range. And then now we had another wick, early September, but we have not rebounded back into the range yet, right? So if we don't rebound back into the range, right, if you don't see us rebound back up and then maybe go sideways for a while, then you need to be aware that we could be going down to the 20-week moving average. And we've talked about the 20-week. We're prepared for it. We know it's going to happen at some point, right? One of the sentiments, right, is just get it over with and let's see if this is the bull market or not. If for those who are new to the channel, of course, the reason why we talk about the 20-week moving average is just that historically speaking, during a bull market, the 20-week is where we hold support. So here, here, and all the way up, and you can see that each time we dropped down to the 20-week, it was somewhere between a 20% to a 40% retracement. Even during the bull market, right? I mean, here's another one, a 40% retracement. So this was even during the bull market that lasted from 2016 to 2017. So despite the fact that it looks like it's all fun and games, there's a lot of pain going on, right? 20%, 30%, 40% drops that all went back down to the 20-week moving average. Now, currently, if you take a look at Bitcoin and you look at where the 20-week is, the 20-week is currently, according to this, at around 98.45. Okay, so if Bitcoin were to drop to the 20-week, if Bitcoin, says, this has been fun, but we're going to have to pull back and confirm the 20-week. If Bitcoin decides to do that sooner rather than later, you should be aware of how far that would be. So currently, that would be about a 7% drop. So a 7% drop from here would put Bitcoin at the 20-week moving average. Now, the 20-week moving average is important for a number of reasons, right? The first reason being that it looks like it's historically our bull market support. If we don't hold it as support, we're essentially kicking the can down the road, so to speak, right? Where we're saying, okay, things are going to get bearish for a while. We're going to have to capitulate somewhere and then turn around at some point, get back above the 20-week, and then retest it, right? This is what we've done 2 times already, right? If you go back and look, during this cycle, Bitcoin has already failed to hold the 20-week moving average twice. So this is why I always tell people, don't get ahead of yourself. We still need to test the 20-week. Two of the three main things I feel like have been accomplished, right? We've had the golden cross, right? The golden cross being the crossover of the 50-day and the 200-day. So if you look at that, you can see we had that back in May. So this is the first thing, the golden cross. And for those of you who aren't aware, these golden crosses can occur during an accumulation phase due to natural volatility, right? And if you go back and look at past market cycles, let me delete some of these things so you can see it a little bit clearer. But if you go back and look at prior market cycles, and you look at, say, the 50-day and the 200-day, well, this one only goes back to, so far. Let's switch over to the BLX really quick. So we're going to switch over to the daily on the BLX, which goes back, all the way to 2010. So it's really nice. And what we're going to do is we're going to add on here the 50-day and the 200-day moving average. So what we showed before, during the first cycle, we had one golden cross, okay? We had one golden cross after the first bear market. So this was the first bear market. We had one golden cross, and then it was parabolic, right? And you can see that we almost had a death cross here after this first parabolic move, but we said, just kidding, it's going to continue. So had one golden cross, off to the races. Second cycle, what did we have? You guys know the drill. We had one golden cross, a death cross, and then a golden cross. We're playing tic-tac-toe here. So golden cross, death cross, golden cross, this golden cross led us to the races. These first, this one I guess was just more so to natural volatility in the market. Why would we have more golden crosses every market cycle? I'll give you a minute to think about it. Well, there's natural volatility of Bitcoin, right? So therefore the moving averages are going to cross, but the cycles, and I know this may come to a shock to some of you, but bear with me. The cycles are getting longer. And you can see that, that we had this natural volatility here. First golden cross, death cross. Golden cross, death cross. Now we have a third golden cross. So linearly speaking, right, we might assume that this third golden cross would lead us to off to the races, right, to a sustainable move to 20K over the next, say, year and a half or so, and then we go parabolic after that. That's a linear extrapolation. I mean, extrapolating can be somewhat dubious, of course, right? I mean, what if it's like some other type of extrapolation in terms of the link and the volatility of these accumulation phases? What if it's like a 2x multiple, right? So you have one golden cross the first cycle, then two, then four. So of course we don't really know, and I mean it's somewhat just looking back we can sort of make these projections. But we have had 3 golden crosses, which is one more than we had last cycle. The other thing, right, is that if we switch back to the 20 week, so we're going to switch back to the weekly time frame. Let me just delete some of these little drawings. So let's switch back to the weekly time frame. Now here, when you look at the weekly, you can see that during the first cycle, the first time that we broke the 20-week moving average, let me put on the 20-week. So here's the 20-week. The first time that we broke through it, we more or less held it as support, right? I mean, we had some candles around it, but for the most part, this is what led us off to the races for the cycle, dipping slightly below it here, right? I mean, this is true. We've noted this before many times. There was a slight dip in the summer of 2013, but once we really broke the 20-week moving average and continued to print candle after candle below it, it was the bad news bears, and we continued to go down. Then, second cycle. You guys know what happened second cycle. The first time we broke the 20-week was here, back in the summer of 2015, and then we failed to hold it as support. So no bull market. Second time, we held it as support, and we went up. Okay? Current cycle. What are we doing? First time we broke through, failed to hold it as support. Again, a failure. Second time, a failure to hold it as support. Now we're getting close to potentially testing it a third time. Now, if we can test it and hold it as support, then I think the market will likely recover quickly and just continue moving on up back to the sustainable $20,000 Bitcoin by the end of 2021, early 2022. One of the common questions I get is, why would we not see $100,000 in 2021 for Bitcoin? And I feel like all the data again suggests that it is a lengthening cycle. Whenever someone who's a big proponent of the 4-year cycle theory, posts one very cherry-picked analysis that could hint at the idea of a 4-year cycle, I get tons of questions on my channel about, so-and-so says that it's a 4-year cycle. I don't really care what whoever, I don't care what they say. I care what the data says, right? The data says that, the cycles are likely lengthening. We've looked at that many times. We have a whole video. It's pinned to the channel. evidence for lengthening cycles. There's a whole lot of evidence for it. Anything else, if you want to cherry pick data, of course, you can come up with natural volatility movements that would suggest a 4-year cycle. And by the way, we don't completely discount the chance of peaking in 2021. We just say that there's a very low probability of it. And that the chance that we peak in 2021 is probably less than 10% in terms of, say, a new paradigm shift in the price of Bitcoin. What's more likely is to, say, see a sustained move, again, to $20,000 over the next 16 months or so. And this is one of the things we're talking about. So this is the BLX. It shows the current price at 11.4. As we know, the price has dropped well below that. It's currently at around 10.6 or 10.7. This just shows daily closes. So if we were to plot it at where we currently are, we are currently right around here. Okay, so this is where we currently are. And what we've noted, right, in terms of these long market cycle moves, right, is we have these, these parabolic moves, the bear market, and then a slow move up to the prior all-time high. Once you get to the prior all-time high, Bitcoin goes into price discovery mode, and then it goes parabolic, right? You have the bear market, a slower move to the prior all-time high, and then it goes parabolic. Again, a bear market, a slow move to the prior all-time high, and then it goes parabolic. We admit we could see some short-term bubbles in the meantime, like we saw in 2019, like we even could still see in 2020 if things just turn around, which they quickly could, right? I mean, Bitcoin was at $3,800 in March, and we're still sitting at 10,600. So from the macro perspective, Bitcoin is still on course. If anything, it was ahead of schedule, right? If we just look at, say, drawing a line from our low to where we would theoretically project us getting to our next all-time high. And the reason I say that, right, is because you look at the last cycle and you can see that we reached our prior all-time high within our fair value logarithmic regression band, which of course is fit to non-bubble data. We reached it within that band. If we were to do the same thing, we're talking about at least another 16 months, right? I've often said the end of 2021 or early 2022 is when we would reach a sustainable $20,000 Bitcoin. And not really a moment before. And we've said, it could go up to 20K in the meantime, but even if it did, it probably would come straight back down and then continue on up. So again, I think that it's going to be a slow grind up to 20K, as I mentioned many times before. If you want to talk about 4 years, go for it. I just think that there's overwhelming evidence to support the fact, or to support the opinion, I guess, that you're wrong and that you're hopeful, and that these other cherry-picked metrics are more so for marketing and getting clicks and likes, rather than telling you, what's more likely to happen based on what the data suggests, right? So the data suggests that it's a longer cycle, and that we're going to likely, come down to the 20-week moving average several times. Now, the question, right, is, are we going to do it now? And this is anyone's guess. I can't tell you, of course. I mean, I don't know. The 20-week moving average is only a 6 or 7% drop, again, so it's really not that far away. So it would certainly be on the cards. I would not encourage people to freak out, right, if we drop down to the 20-week. What we want to see, of course, if we drop there, is a hold. We want to hold the line at the 20-week moving average. Do we care about wicks below it? No, right? In fact, if there's a wick down to 9,600 to fill the CME gap that so many people think we need to fill, then great, right? What we care about is holding it as support on a weekly time frame. So looking at these weekly candles, right, and seeing that this is what we want to hold as support. We want to make sure that the weekly candles are closing above the 20-week moving average. We hold it as support, and we continue our way up our systematic move to 20K. Again, as we've said, I mean, there's always a chance that we don't hold it, and we kick the can down the road. And we could drop, in terms of the regression band, the lower bound on the regression band currently is 63.13, which, by the way, is basically where the 200-week moving average is. So if you look at the 200-week moving average, if we were to fall down to the 200-week moving average, it more or less corresponds to the lower part of the regression band at the present time. It's slightly higher, but it will cross over soon. And again, if you go back and look at the last market cycle, once the 200-week moving average crossed below the fair value regression band, we ended up moving up. And where did it enter? Where did the 200-week moving average re-enter the regression band? it happened identically at the peak of the cycle. That is where it happened. So if we repeat, what we're looking for, right, is to slowly see that 200-week moving average, cross over the regression band to continue coming up. The price of Bitcoin can do whatever, really whatever the hell it wants to do. But just hopefully that it continues a slow move to 20K. Once we get there, again, we go into price discovery mode over the next, say, 12, 18, 24 months, and then we go parabolic, right? And maybe we go to 100K, maybe we go to 80K, maybe we go to 180K. I don't really know, but what I will tell you is that I'll be basing it off the risk bubbles, which we talk about on the channel. We'll also look at this, this regression band up here, as we extend it out. It just automatically gets extended. Of course, the equation does not change and will not change this market cycle. So, what we're looking for is business as usual, more or less. I mean, it is unfortunate that we're not holding, we're not staying in the accumulation range for now. But at the same time, we knew at some point we're going to have to test the 20-week. It remains to be seen if that's going to happen today, tomorrow, next week, next month, 6 months from now. I don't know. In hindsight, as we've said, maybe we'll quickly pop back into the accumulation range, and next week people will be laughing about the capitulation on September 3rd, right? This is a possibility. But we also have to be aware that a move to the 20-week will come at some point and that you should be ready for it. So what does being ready for it mean, right? Well, if we move to the 20-week, if we don't hold it as support and Bitcoin drops below it, then for most altcoins and Ethereum, I don't really consider Ethereum an altcoin, but most coins are going to lose value against Bitcoin once we get to that point. Yes, they're going to lose value now too if we continue dropping to the 20-week, but once we get to the 20-week, if Bitcoin decides to then drop to the 200-week moving average, which is like, $3,500 lower, during that drop, most altcoins will profusely bleed against USD and Bitcoin. And this is why we always say, Bitcoin, if you're taking profits from coins like Ethereum or altcoins and you're wanting to take profits from crypto to crypto rather than crypto to USD, a lot of times Bitcoin is a safe haven because yes, it will drop. If the market's dropping, right, it's because Bitcoin's dropping. So if Bitcoin drops, the entire market though will likely drop more. Yes, you can cherry pick a few coins that might perform better, but for the most part, the market as a whole will drop more. So this gives you continued exposure to the crypto market while also taking profits from coins like Ethereum and Chainlink, Cardano, other coins we've talked about on the channel, back into Bitcoin, right? So this is how you can maintain exposure to crypto, right? If you don't want to keep it in cash because you're losing value to inflation, and maybe you don't want to go in traditional markets because you think they're overvalued too. So you're like, okay, well, I want to keep it in crypto, but I recognize that the specific crypto is up, 5x or 10x in a very short period of time. Therefore, I want to move it into a less risky crypto. Bitcoin is typically your go-to. Again, this is not financial advice. This is just, I feel like, what the data has suggested for the cryptocurrency markets for the last 10 years, and will likely continue to do so. So again, let me know what you guys think. We do have, if you want to play-by-play, I do frequent alerts on the Telegram channel, the private Telegram channel. Again, if you want to check that out, check out the premium list at intothecryptoverse.com. You'll get access to the premium Telegram alerts channel where I'll basically give you a play-by-play, a lot of times daily updates. There's a chat room, private chat room, the weekly reports, the weekly videos, the risk dashboard, which is what I used to trade, which has come it's been coming in handy a lot recently. So just ask the other people that use it. And then the strategies dashboard in terms of how do you dynamically DCA out of a market when it's in bubble mode, and the greed within you just makes you want to FOMO into the market. So again, I can assure you that it's more of a mathematical approach. It's not based on emotion. If you're more so based on emotion and you just want to like swing trade based on how you're feeling that day, this is your prerogative. This is not the purpose of the channel. or the premium list. So if you're looking for a more mathematical way, a more systematic way, it basically, in the way I think about it is it creates like a secondary revenue stream, right? You have your revenue stream from your job, maybe you have it from you're renting out some properties. I contend that you can have one with crypto, right? You don't let your emotions get the better of you. You buy when the risk level is low, and you sell when it goes up. And the risk level is something that I cover on my channel. The equation is not published, but you can see many videos on it, and you can see me. I've back tested the results to show you how things would have gone. We looked at the different approaches in terms of dynamic DCA versus DCA, and it essentially takes about one market cycle where dynamic DCA always wins out over regular DCA, and it wins out quicker the earlier in the cycle you start doing it. So like if you start doing it late in the market cycle or late in an accumulation phase, it's not as useful as when you start early. So this is the idea. That'll wrap it up. I hope you guys enjoyed the video. So just keep an eye on Bitcoin. 10.5. It seems to be, as I've said, like it seems to be a potential wick, right? 10.5 being that low or that high, that local high in February of 2020. If you see us go below 10.5, recognize the 20-week moving average is not too much further down. Approximately $9,800, give or take, right? What's a few $100 among friends here? But yeah, we'll follow it. I hope you guys enjoyed the channel or enjoyed the show. Make sure you subscribe to the channel. Please give the video a thumbs up, and I'll see you next time.